Hi, I'm Rachel.
Hi, I'm Adrian.
Hi, I'm Chang Wen, and we are from the UOBAM Invest team.
The idea behind the UOBAM Invest mobile app is to actually democratize investment to allow retail investors to gain access to professional investment capabilities from an asset management company.
So the UOBAM Invest app started off as a corporate service. Subsequently, we did a survey and we found out that many of them were interested in using it on their personal basis. And with the increase in mobile penetration rates, we decided why not provide it as an app for the masses.
What makes UOBM Invest stands out is that it's basically an app that is built upon over 30 years of experience managing large institutions' monies. So we translated the experience in that space into the mobile app so that actually the retail clients, the men in the streets, can get access to such services.
The UOBAM Invest mobile app has been designed with our customers in mind. This will mean that we aim to deliver a personalized experience. For example, when you walk into a store to buy a dress, the sizes there are fixed where you can either choose a size 8 or a size 10. However, from our robo-advisor, the solutions that we provide to our clients are actually tailored to the needs and to the goals that they shared with us.
We worked as a team to make sure that requirements were gathered from all the different stakeholders.
We even have like our AML team where they are heavily involved in the project to ensure that the onboarding journey for the clients is as smooth as possible. And also at the same time, we have to make sure that all regulatory requirements are met. We also work closely with the Group Technology and Operations department in UOB to ensure that the security part of the app is well taken care of.
It really felt like having a child. And for Rachel, I think it literally is.
She delivered a baby during our project.
Yeah, so I delivered 2 babies this year. When we first launched the mobile app, we have actually gathered user feedback, look at data in order to decide where we can actually enhance and how we can enhance the customer experience and customer journey.
And based on the client's feedback, we then adopt an agile approach to basically releasing such enhancements to our clients within a very short time frame.
My biggest takeaway from this is the value of being united. It's heartening to see everyone putting in the extra hours just to see this app come to fruition.
We have to be enterprising, be able to think out of the box for our customers, work with like-minded partners to be able to execute our plans.
We believe UOBAM Invest can change the future of personal investing by lowering the barrier of entry to just $1, making it accessible to the man on the street.
So to summarize, low minimums, ease of access to financial advisory services, and ease of access to basically your portfolio information are some of the key things that we believe UOBAM Invest will serve you for your investment needs.
Hi everyone. A very good morning and welcome to our virtual workshop. I hope you enjoyed the video earlier where our UOBM Invest team shared their experience on building the app, some features of the app, and as well as how they basically gave birth to the app. A big thank you for spending time with us today to learn more and hear from the experts. I'm Bernice Lau, a member of the UOBM Invest team, your host and moderator for the exciting webinar that's coming up. Now, for those who are not so familiar with UOB Asset Management, UOB Asset Management is a leading regional asset manager that has investment experience of more than 30 years. We are wholly owned by UOB, one of the strongest banks in the world, and are present in 9 markets in Asia. As of 30th of August, we have 33.5 billion assets under management and have most recently been awarded with the Best FinTech Innovation in Asset Management Singapore Award. Next up, we are excited to share on the agenda today an introduction to active and passive investing, and how the funds industry has evolved over the years. We'll then follow up with a fireside chat with our industry veterans on their views on whether ETFs will eliminate the role of active management. Finally, we'll end off with a quiz at the end of the session with some prizes to be given away. So do remember to pay attention. Okay, now let's do a quick poll on the topic for today. Do you think that ETFs will eliminate the role of active managers? So the purpose of doing this is so that we can understand before and after the session whether there are any change in views after listening to the experts and all that. So we do look forward and hope that you'll participate in the polls. I do see quite a bit of participation, and yes, it's very heartening to know that at this point, 77% of our audience here think that ETFs will not eliminate the role of active managers. We are not here to convince anybody to think otherwise, but we are just here to share our opinions, and hopefully you'll learn something and gain some insights after this session. Okay, now for us to understand the audience a bit better, we'll run through our second poll. Have you heard of or invested with a robo-advisor before? This is a question that we ask basically everyone that actually attends our webinars, just for better understanding and with regards to the market, whether people are familiar. Okay, it's very good. So the majority says that I have heard of but have not invested with a robo-advisor. So hopefully after learning more about ETFs, active management, basically investments in general, you'll be able to start to explore not only robo-advisors, but just try to start to build your wealth through investments. Thank you very much, the audience. And okay, this is an introduction on active and passive management that I would like to run through. And before we bring in the experts. So active investing requires a hands-on approach, typically by a portfolio manager or other so-called active participant. Passive investing typically involves less buying and selling and often results in investors buying index funds or other mutual funds. So what are the key differences in active and passive investing? So for active funds, they are usually intended to outperform a specific index called benchmark. So imagine if you are buying the Straits Times Index, you are actually trying to, if you are investing in a fund that's investing in Singapore equities, we'll probably be trying to beat the STI Straits Times Index and outperform. Okay, and for active funds, they usually have human portfolio managers and analysts. They tend to have higher expenses to justify this outperformance of indices. And for passive funds, they are intended to mimic and not beat the performance of any specific index. So what they're trying to do is to track the performance and of the Straits Times Index using the example that I shared earlier, and are generally automated with some human insight, definitely lesser than the active portion, and tend to have lower expenses. So this is the introduction, and before we begin, the main differences that you need to know. And just as an example, ETFs typically fall under passive and mutual funds or unit trusts under active management. However, with the growing demands of consumers to obtain more cost-effective products with better returns and advancement in investment technology, we have started to see a convergence of these two. So despite the differences, they are actually coming closer and closer in order to provide a better solution and better product for consumers nowadays. So what better way to witness and understand this convergence than at this webinar, where we have representatives who have a tilt to both active and passive investing. Introducing our guest speaker, Mr. Richard Xiao from VanEck, representing the passive tilt. Okay, so just a quick introduction on Richard for those who are not familiar or have not met him before. He's the lead for regional business development in Asia. And prior to joining VanEck in early 2018, he served various stints in both active and passive fund management companies. So Richard is someone who is very experienced and will be able to take us through and share some valuable insights. Hi, Richard. Welcome.
Hi. Thanks, Bernice, for inviting us, and thanks, UOBAM, for the lovely morning.
Welcome. So next, I'll move on to Damo, who is our resident speaker. So Damo, for those who have attended our webinars before, you should be very familiar with him. He's our Chief Investment Strategist for UOBAM Invest and responsible for providing leadership in the investment aspects of the UOBAM's digital platform. He also concurrently heads the Investment Partnerships and Solutions Unit at UOBAM. So let's welcome Damo on the screen.
Hi, Bernice.
Hi, Damo. Welcome. It's been a while since you joined one of our webinars. Thank you for joining us today again.
Thank you.
Okay, I think now that we have both speakers on screen, let's be polite and start with our guest, Richard. Okay, so Richard, first question for you. I believe for some of the audience today, they might not be as familiar with VanEck. Would you be able to share more about some of the capabilities and the history of VanEck and a quick introduction with us?
Yes, thanks, Bernice, for the question. I think easier would start off with an introduction of what we do. and to lend some background so that we can help to pace this conversation and this topic around active versus passive. So VanEck is a US-based global fund manager founded in 1955. So we started in the US, and what has since then is we've started as an active manager. So back then we were one of the earliest fund manager to offer international investing to US investors. And in the 1970s, where VanEck really found its stride was that we started investing into gold equities. Now, maybe back then, gold equities was something that people would not think about as much, but along the way, I think as of today, I think it has become something of an portfolio asset class allocation. So we were active till 2006, where we started into the passive space. So we launched the first ETF in 2006. And as of right now, we have over 100 ETFs. And across the AUM split, we are probably 80% in passive and 20% in active. So we continue to balance that in terms of active and passive expertise, because that's where the brainchild and the DNA of our active managers do help a lot in coming up with passive strategies.
Thank you so much, Richard, for the introduction. So, for the purpose of this fireside chat, based on the history and the capabilities, let's just say you have a tilt towards passive investing, and you could be representing a bit more of the voice of the passive industry, or from your own point of view. Okay, and we'll have Damu, who is obviously from UOB Asset Management, and he will be representing a manager with a tilt towards active management. Okay, so that's for the audience understanding. So let's start very quickly. I think we do not need to touch on too much about UOB asset management and the capabilities that I've already shared earlier. So, Damo, first question is for you. Okay, what do you think are some of the challenges faced by active manager?
I think basically there's a lot of criticism on active managers in a sense that as an industry, the argument is that we don't deliver the performance that's expected. In a sense that I think you hear a lot of common criticism that active managers generally don't outperform the index, so why should we be paying them that? Excuse me. And that's basically a common refrain we hear a lot from society at large or from investors at large with regards to active managers. And I basically would want to basically put a bit of defense here in the sense that I think the reason that you see that active manager faces this challenge that we sometimes find difficult to beat the benchmark the benchmark as a whole is simply the benchmark represents the market. So if you think of the benchmark representing the market, and we have difficulty beating the market as a whole, is that it's not that the active managers are stupid or silly, right? It's not that. It's really, if anything, I think we have too much intelligent people in the industry, and I think that intelligence is sort of there's no monopoly on intelligence, and basically it's actually very widespread in the industry, and therefore it's difficult to find an active manager that consistently outperform the market, simply because different managers outperform market at different times, and therefore you end up, and when you measure it, it seems like no one seems to be outperforming the market consistently. And I think that's really a matter of too many people trying to find what we call alpha, or trying to find the inefficiency, or trying to profit from the market, and because of that, no one could really profit from the market much. I think this is what we term the efficient market paradox, in a sense that because so many of us is trying to find believes that market is not efficient, and we are trying to find the inefficiency and trying to exploit that inefficiency. and we do put in a lot of research in trying to find that inefficiency, the market actually became very efficient as for that reason, and therefore it's difficult for active manager to really profit from the market. I think that's probably one of the biggest challenge we have.
Thank you, Damo. So, with regards to this challenge, right, um, Richard, so could we get your view? Do you agree with what Damo mentioned, that it comes from the paradox of having too many people searching for yield, searching for at the same time, and as a result, that there's some difficulty in beating the market? Would you agree with that statement?
First, I would say that it's active management is indeed a crowded space, as we have seen over the many decades of more and more managers coming into this space. And I would say it more from the perspective of one is, well, it's sometimes it's very difficult to say that active managers don't outperform. I like to lend some credit to active managers first, because we started our roots as active managers. So I would say that active managers do not necessarily underperform in all asset classes. And we have seen that in certain asset classes where active managers do outperform in some of the asset classes that we mentioned. So it's in a broad stroke, it is not right to give it just a a one stroke to say that active managers do outperform or do underperform. Now, on the other hand, where ETFs really come in handy is the ease of just forming a portfolio. Now, as we all understand, ETFs are very much, we look to track a benchmark. We look to make sure that we replicate a benchmark. And where that kind of stacks up would be where you can see that it's very much just rules-based, or be based on the index methodology. So when you look at an index methodology, and then you look at the complements of a lower expense ratio, that makes it challenging for the active managers to try to stack up. Now, where exactly it makes more sense for active managers we've seen is in certain asset classes, like the small mid caps. We've seen that has played out quite well in less efficient market, lending to what Damo has mentioned about the efficiency paradox. Less efficient market, we've seen that as well. And these continues to be an area that will make it very challenging for ETF providers like us to constantly say that we have an edge. But where we try to differentiate ourselves as an ETF provider is, first, the fees expense ratio low, the ease of building blocks to form a portfolio, and thirdly is clarity. So you know exactly when the index rebalances, you know exactly what's in your portfolio, and you know exactly how to go about making sure that you don't have overlaps or correlation works in your favor.
Thank you so much, Richard, for sharing that. Damo,
Sorry,
you have
Richard.
something to add on?
Well, actually, a question for Richard, a comment for Richard is, doesn't that mean that ETFs are basically free rider in this whole thing, right? Active managers like us make the market efficient, and you guys simply write that efficiency. You just assume that the market price is always right, and therefore you don't really have to think that hard about it. You just go in and replicate that market. Aren't you guys simply basically a free rider in terms of all the costs that active managers like us put in terms of doing research and everything?
That's a very good comment, Damo. I like that, and it has shown. You're like over this year, you have seen how the flows have gone into passive, and how that has gone tremendous or gargantum in terms of the AUM that passive managers manage. So if you look at the free rider issue, or the freeloader issue, as I want to put it that way, I think where it really boils down to that is that we feel that the ETF as an asset class is just to offer that free access. Now, obviously, there will be time where people start to think about beyond just market beta ETFs. We tend to think a little bit towards differentiating ourselves or offering values beyond what active managers try to offer. So let's give it an example. We look at a research-based index methodology like a smart beta, right? So that itself has got, I would say, a complement of active and passive. So you have certain rules, like for example, high dividend, high ROE, low price, low PE ratio. These things would help us to come up with a portfolio that as much as to differentiate ourselves from the market beta. So I would say that the free rider issue or the freeloader issue is something that if you were to think about it, it's probably is just the way that assets have been coming in at great speed, that we ourselves found that is a result of a couple of things. One is that is just the ease of getting access into the market, and that liquidity of ETFs have been amazing. And to that end, we see that where active managers, like most other active managers, would be thinking about the challenge of how do I come in as close with an active manager. So I think that if you were to look at it, that the active versus passive debate, I think passive have evolved quite a long way to where it is today as compared to the first passive ETF.
I would argue that you guys did great management, great marketing, right? Even Warren Buffett says that most people should just invest in a passive index kind of thing, right? And he's an active manager himself. Berkshire Hathaway is actually an active manager, but even he tells people that you guys should go passive, so that he can go and find the inefficiency if more and more people go passive, right? So I think you guys have done a great job in terms of marketing passive. But I think I mean, besides the fact that your assumption is that that the market is always efficient, and that efficiency is caused by is really brought by us throwing in money, throwing in research to figure out to try and find that inefficiency. But don't you think that passive also? I mean, one of the criticism of passive is that you are actually causing greater market volatility, because passive generally is non-thinking, right? As long as there's inflow, you always buy. You don't care if the market is overvalued. You don't care if any particular stock is overvalued. As long as it's in the index, you basically just buy according to the weight in the index, right? So it's non-thinking, but because of that, you cause greater market volatility, because it becomes a very momentum-driven kind of strategy, right? When you have a lot of inflows, you just buy, and then when there's a lot of outflow, you just sell. You don't think whether it's now cheap or anything. It's just about flows, right? What do you think of that? I mean, you are actually exhibiting the whole market volatility because of momentum.
Oh, that itself, that's a great observation. I would say that there is a lot of flows driving, pushing valuations up, pushing market momentum, and that continues to be the case, especially even where we see what happening on the this year, particularly since March until now. And I would say that active managers haven't done too badly this year as well. If you look at them, even though passive have done really well, I think the conversation comes around when people would say, so with valuations so stretched and lofty, wouldn't it make sense to think about an active manager where there could be pockets of undiscovered gems and jewels? So I do think that where we have come into the space makes it even more valuable when you guys show your stripes that you are doing a great job.
Okay, thank you so much. So I caught something earlier. So Damo, you were saying that the passive industry has done very good marketing. So that's what has resulted in more awareness and everything. So do you think, Damo, that the active industry should be doing more? Or is there something that we are lacking in order to promote the strategies and all that?
I think to be fair, I think the active management industry has had too many, let's call it, benchmark huggers. So there's a lot of mediocre performance in which that because they don't have a clear strategy or a clear investment philosophy or process, they basically end up the only objective is trying to beat the benchmark. And if they can't beat the benchmark, they basically just hug the benchmark. Those are what we call closet benchmark huggers. There are too many of those people. And what we are seeing is, and what we should see, and what we're seeing is that the industry would actually consolidate. I think a lot of these managers will gradually disappear. Some of the managers may merge for cost synergies purposes. But what we really need to actually is to start delivering on that promise that we are really doing active management, and we are really delivering better value than what the benchmark can deliver. I think that's probably what we should be doing, or at least for a manager, for any particular manager, that should be our objective, meaning that trying to deliver more than just what a passive can do. I mean, if what your portfolio is really looking like what can be done via computer, then you don't deserve to be there. I mean, as Richard just now mentioned, right? Today, if you claim that you are a growth manager, but all you do is basically picking names that has the highest growth in the portfolio, I mean, today there is growth ETF that can do that for you, right? How do you ensure that you beat that growth ETF? I mean, if you claim to be a value manager and all you do is pick the lowest price to book kind of stocks, there is a value ETF out there. I think those are questions that we need to ask as active managers. Where can we add value besides doing all this very simple sort of rules to pick to create our portfolio? And I like to my sense is that where we are better than sort of the passive strategy is that passive strategy generally don't have foresight, meaning that they don't look forward. And I think the idea is that as active managers, that's what we are being paid for. We are supposed to have insight and foresight and sort of be forward looking, so that we go where the ball is going rather than going to where the ball was. And I think that's basically where I think active manager probably at the most value.
Okay, so thank you so much, Damo. So sorry, but I'd just like to jump back to the free rider issue that you posed to Richard earlier, right? So we have a question from the audience, and I thought it's apt to slot it in right now. So in relation to free rider issue, do you think it could have been attributable to greater information access and lower cost of procuring information? So the main thing is that what are your views, both of your views, the difference compared to the past in terms of information that is available made to the masses that has resulted in possibly the evolution and the rise of passive strategies? Maybe we can start with Richard. What do you think about information access and cost of procuring information?
Well, I would say that the way to look at it for passive is that where active managers would try to look for the information inefficiency and try to outperform on that basis, where there could value or upside to be captured that has not been covered by analysts, or that sector has been in a way in the dark. Where we come in is not as much as that information has made sense for us, but what we try to come in is that we look at where investors might not have that particular representation in their portfolio. I give an example of a simple analogy. Like if we were to think about the S&P 500, right? So everyone would know that is very low cost to buy the S&P 500 ETF over most exchanges, and you get access to 500 names in the single index. Now, where active managers would try to come in is they would try to say that there might be areas that have been under researched, and sometimes they might go value, they might go growth, momentum, quality, and a mix of different factors that comes in. Now, where we try to do is that we would try to say that, look, I'm not able to compete as a ETF issuer with someone who can do it for 0 fees or 1 basis point or 2 basis points. Now, where I try to come in is to partner or to internally have a research team to look at things that we think may not have been covered. We look beyond the what we see on screen on PEs, PBs, and just we look at it from the perspective of, do these companies have a competitive advantage? What's their SWOT analysis? What's their Porter's five forces? So we do each and every name in the ETF, and then we look at how long this competitive advantage, what we classify as moat, will last in the next 10 to 20 years. And then we assemble a product. And then when we assemble that product, what happens then of that is when only the valuation piece comes into the front for us at every quarterly or half yearly rebalancing. And that's when we will look at making sure that these stocks represent good value to the investors, underpinned by solid, robust research in terms of their competitiveness and their competitive advantages. So that's how we will say it. So information to us has got many fronts, and to say to the extent that information is abundance is true in some extent. I think I had in my previous roles, I spoke with many of the founders of firms as well as senior investment professionals who tell me that if you were to start a active manager today, or if he were to start the active management today as compared to what he did in 1970s, it would be a lot tougher. It will be a lot tougher. That's why we see the growth of robo, we see the growth of quant, we see the growth of a lot that relies on just what we call as hard matrix or hard numbers, data crunching and all. And so I don't think the free rider issue for us is just a question of, oh, since we know where it is, we know what it is, and we just ride on it. So there is some amount of elements of investment thoughts that goes behind the product development efforts. So that's where we are coming from.
Okay, Richard, actually that sounds like something that you're doing is more of like something that's in between full passive investing versus active management, because it sounds like there are actually other research processes that come in place in order to go ahead and procure and produce these kind of products. So is that what we call active ETFs? Would you say that?
So I would say that it depends on really where you're coming from. There could be rules-based ETF where we set the rules and we let the rules guide the rebalancing as well, what goes in and out of the portfolio. And there are also real active ETFs that are very much the fund manager, where human fingers are put into the systems or human efforts are put into the system to run it exactly like an active manager. So ETF has definitely evolved a long way to in that extent of things. Yep.
Damo has something.
Yeah. I think it's interesting. I mean, we saw that trend in a sense that after sort of the initial phase in which that we are talking about sort of ETF being passive, and then after that we start seeing people trying to introduce some sort of rule-based intelligence into the ETFs, whether you're talking about the smart beta ETFs on growth or on value. Now we are gradually more and more we're seeing gradually more and more ETFs. They're basically taking a more active role, like what you mentioned. I mean, what you described really, you're finding companies with strong moats and then look at valuation and then make and really sounds like what a fundamental active manager would do, right? So to me, that really sounds like a very active ETF, and I've no qualms about that. And I think the idea is that, to me, after a while, what I reached a conclusion was that ETF is not about it's not really about disrupting the investment process. ETF is really about disrupting the distribution process, right? So you can have ETF that is really very active, whether you have human manager behind it and everything. But what is happening is that it is not being distributed as a unit trust through the bank branches or through financial advisors, but it's simply listed and traded on the exchange, right? So that's what ETF for you. But the thought process behind it, or the investment process behind it, could be active, could be rule based, or could be active, could be even, as you mentioned, having a human that basically is very actively trading that portfolio. So I think the whole active passive debate initially was centered around ETF, but I think that's because ETF as an industry started off marketing it itself as disrupting investment, right? It's simply as replacing the investment managers. But actually, what we've seen is that, as Bernice pointed out in the beginning, is we are starting to see that convergence between ETF and sort of unit trust, because really the difference between ETF and unit trust is really about the investment vehicle, and it's really about the mode of distribution rather than the investment process.
Thank you so much, Damu, for your insights. I think what you were trying to share earlier was basically your view on uh, how ETFs and active management will actually converge. And in actual fact, it's more of a disruption to distribution than more than anything. So I was just wondering, Richard, do you have any comments or any opinions about that? Do you think that's what's happening? Um, if you're talking about an investment vehicle, are ETFs and like for example unit trusts and mutual funds just different vehicles, but ultimately still something that we're trying to do with to enhance and to that's supported by research in order to provide a solution for our consumers. What do you think?
Let me take the stand of a institutional investor or an institutional portfolio manager. Now, if you look at it, we think that if you're an institutional portfolio manager, you would like to assemble a basket of stocks, and you would like to make sure that these basket of stocks outperform. We use as example like a global equity portfolio. If you could have a team of 60 analysts, you could analyze the whole worldwide universe. But if you only have a team of 5 to 10 analysts, you probably only can do like a geek sectors, or you could just really just slice and dice it as broadly as possible. So where do we really draw the line in this case? And now, where I think active management has done well is the use of ETFs in these kind of broad mandates or broad multi-assets portfolio, where say for example, if I'm sitting in Singapore and I run a global equity portfolio with an allocation to something like Russia, the chances are, unless you have someone who is very well adept at Russian equities, you might just end up using a Russian ETF. And that does not mix any lesser of a talent of a active manager, because he would know when valuations are stretched, when to exit, when to underweight, when to overweight the Russian ETF. Now, in that same vein, that's when, if he has an expertise in Asian equities, naturally he would find himself in the sweet spot of picking stocks. And the cost of probably picking stock and executing through an institutional broker is way lower than he would have bought an Asian equity ETF. So I think that vehicle usage has become a hybrid model. That's coming from the perspective of an institutional portfolio manager. Now, where if you today I'm a retail investor thinking about my own retirement planning, or thinking about where I would like to allocate my portfolio, I think that's where you will see that the vehicle wise is something that you would consider from a few perspectives. One, of course, is fees, being you want to make sure that whatever goes lesser into the pockets of distributors goes into the markets. The more it goes to the markets, the more it participates in market upsides. That's the first thing that you want to think about, and that's when you will see that you would naturally gravitate to ETFs and not active funds. But on that same note, I would also lend credit, I think, to active managers as well. We have seen where certain spaces where it's high dividend, high yield, and where there's income focused, we see that the conversation around active still remains very, very strong. So it's a question of your needs as an investor versus what sort of vehicles would suit you best. So I would say that it's coming close. It's coming close, but we see that ETFs don't really behave in a way that says that we are going to be the future as much as we would love it. From my perspective as an ETF issuer, we don't see that happening, and we still see that certain themes, certain needs of the investors are still well covered by active managers. Now, I like to land this point here for active manager is I can understand that in databases of comparing active managers, sometimes the challenge of an active manager, and if Damo could add on later, is trying to be trying to stand out from the rest of the active managers. Maybe you could be an global equity manager with a certain tilt or a certain slant towards certain metrics or certain factors or certain areas where you think that that's where your strength and expertise lie in. But you have to participate in a MSCI equity index because that's where everyone is looking. That's when everyone is. So I think that's when I feel personally that active managers find themselves that if I can get a chance to showcase myself based on a strategy benchmark that fits the needs of my portfolio and my client understand that this is the strategy benchmark instead of a published benchmark, maybe that might help active managers to market their strategy much better.
Thanks, Richard. I mean, you're sounding more and more like defending us active managers, and I really thank you for that. But you're right in the sense that how to stand up as an active manager is, I think currently basically the way to stand up is by performance, right? And basically the simple things that everyone do is always you screen your performance and you look at whether there is okay. So there's okay, part of my job in UOBAM is actually look at third-party managers as well, and that's basically part of my job. And so the first step we usually do is we do a screen of those managers and says, how have you performed? And that's basically the first step that we always take in terms of trying to pick the manager. And then it's after you say, how have you performed? And we would ask the question, things like, how do you deliver that performance? And that's when we sort of do a deeper dive into the investment process. You know, have you performed simply because of luck, or is it really because of skill and things like that? So usually that's how we start a manager search process. And so I think for us, for active managers, the first thing that you really need to do, and that's us as well, is one, you have to deliver performance. Two, you need to be consistent in your performance, right? So you don't want a manager that is first quartile in 1 year and then bottom quartile in the next year kind of situation. You rather have someone that's probably near the first quartile. He may not be the top decile, but he's always top quartile for the last 5-10 years kind of situation. There we know, okay, there is consistency in that performance, and it's likely to be attributed to skills or process rather than luck. I think that's basically where I think active managers need to stand out. Whether that benchmark is equity or obviously you want a benchmark that suits your style the best, but unfortunately, as you mentioned, everyone tends to use a very broad benchmark. If you're talking about global equities, it tends to be the MSCI AC World Index or All Country World Index. That's basically the equity, and that's sort of unfortunate. But we have to take whatever that comes along.
Thank you so much, Damu. So I think from what I gather from both of your responses, the fact is that it seems like we can be frenemies. So we can be friends and enemies at the same time, competing and also working together in terms of how we can present the best kind of solution to an investor. And it seems like what I gather over here is that distribution is something that could be affected, but at the end of the day, it's still dependent on several factors. I mean, there's still one white elephant in the room that we have not touched on yet, which is the difference between passive and active in terms of fees. So, Damo, when you mentioned distribution earlier, we have a question from the audience. So the question goes, can active management fees ever drop? For example, maybe sales charge and all that to compete with ETFs more effectively, especially since you mentioned that it was a mode of distribution. So although both can coexist, but this white elephant in the room of fees, of whether it can go lower and all that, will always be there. So maybe Damo, you'd like to take the question?
Okay, I think it basically starts from historical perspective, historical legacy, in a sense that in the past, how unit trust or mutual funds is being sold is always that, as I even mentioned it, is a product that's being sold, meaning that no one actively go out and search for a unit trust to invest in. It's always usually happens at a bank branch. The bank teller looks at your bank account and says, Mr. So and so, you have 20,000 in your bank account, and today interest rate is very low. Why don't you buy a unit trust instead, right? And so you have someone push that product to you or sell that product to you, and for that, basically, in all for the distributor, he needs to be paid in order to have people push that product, right? So that's how sales charge came about. So that's why initially it was almost 5% that sales charge that we charge, sort of distributors charge the investor in order to sell that product to you, because a lot of investors need convincing to buy a fund, and that process could be long. So that's how historically sales charge came about. We have distributors and things like that. Today, if someone comes and says, I'm looking to buy, right? I'm looking to invest for my retirement and I'm looking to buy, why should you charge me a fee when I'm the one that's doing the buying? I think that's sort of changed that mindset especially among the younger generation. If you tell them and says, hey, for the privilege of investing your money, pay me 3%. Nobody is going to do that anymore, right? So that's why sort of distribution fees is gradually coming down, but at this moment we don't know how much it will go down till. But it's a trend that we have seen, in the sense that more and more people says, if I am actively looking to invest, why should you charge me for buying into your unit trust or buying into your funds? And I think that's probably a fact of life that what we are seeing in distributors. So the sort of, in a perfect world, we would love to say, okay, here are our funds. If you can be self-service and buy the funds off our website, there's no distribution charge, right? So that's the perfect world that we are hoping that we move towards too. But the truth is that there's still a lot of investors out there that requires guidance or requires sort of recommendation what funds to buy, or given a little nudge in terms of investing their money, and therefore the role of the distributor is still there, and therefore there is still the effect of that sales charge. But gradually what we're seeing is that the trend is moving towards lower and lower distribution fees, and if you buy online, there's really no distribution fee to speak of, right? So that's basically the trend. And then in terms of management fees, I think the interesting thing is we're actually seeing a convergence of management fees. ETF used to be cheap, but as ETF gets more and more sophisticated, the fees are going up. Unit trust used to be expensive, but with the pressure, and as we can start distributing directly, and we don't have to share that management fee with distributors, actually our fees is coming down, right? So I'm actually seeing that convergence between sort of ETFs and unit trust on the management fee side. They're at least moving in a converging direction. So I think the big elephant in the room, or the answer to that question is unit trust or active managers fees are going to come down. And at the same time, what we are seeing is that ETF fees are actually going up. So basically, ultimately, we'll see more and more towards a convergence.
Thank you, Damo. I think that was a very good answer. It basically addresses even my own concerns about whether, as professionals in the asset management industry, what's going to happen, and whether we will be affected in any other ways. I would agree that it is basically converging together, and it's not a total elimination of both sides. No matter what, there will still be people who need guidance, as you said, and there will still be people who are able to actually make their own decisions simply because either they are not from the industry, they have no time to actually understand all these kind of various investments, that where they still need guidance, and from there it's only fair that there are still some fees that are given to those people who are offering a offering professional advice. Yeah, thank you so much, Damo. So I think it's 11:50. We have time for one last question, and I think the question is addressed to Richard. So, Richard, could you please share about VanEck's ETF's inflow outflow trends in the past years and this year during the pandemic? Do you have some figures that you are able to share compared to the flow of other kinds of funds in the world?
Right. So thanks for the question and allowing me to share a little bit about VanEck. I wanted to keep this very much just to the discussion of a active versus passive debate, but I would just give a quick shine on where we have seen flows coming in this year. So the interesting thing is that I would start off with the start of the year, right, when the pandemic actually hits. Probably you see the worst impact coming in from the lockdown would be somewhere in March. That's when we see there is a lot of outflows coming out of fixed income products, because that's when fixed income products, naturally you are squeezed, the market makers is squeezed, and the market participants are squeezed as well, trying to look for bonds. So let me just wind it up a little bit by understanding that in order for us to form an ETF, we need to buy the physical bonds in the market for fixed income, or buy the physical ETFs for ETFs that tracks equity indices. So the March issue was that we had a wide bid-ask spread, and I think that's a time where we got in the limelight for the wide bid-ask spread, and and market makers scrambling to try to cover their shortfall or demands of the liquidity in the market itself. And I think that's an area where we see active managers may not go through in the same severity now. But what has happened since then is that from April onwards until the year that has come right close to Christmas now, we've seen that ETFs have really come up by a large part of it. AUM for us, we grown by about 20% just for this year itself, largely driven by ETF inflows. We see a lot of inflows into gold products. And everyone probably would know that gold is something that a hedging, risk hedge, or you just want to make sure that you cover inflation grounds, you cover concerns over social, macro, geopolitical issues, and that. So gold has done very well this year for us, and we see that continuing to get into the future. Now, the other concern, I think I will address this as well, as it come up in many of our discussion, is that with the vaccine virus, would people continue to see gold trend upwards? So there are a few drivers of gold. Now, one driver of gold is US dollar weakness. The other driver of gold is negative real rates. So while the pandemic vaccine could be seen as shining light at the end of the tunnel, but rates are not likely to come up as soon. So that's a driver for gold. And likely without rates and without a clear line or insight for the US economy, the US dollars continue to be compressed. So these are the drivers for gold. That's why we continue to see lots of inflow into investment demand for gold. Not so much the retail demand like Asian buying jewelries or central bank buying gold as hedging. So this year, the demand has been driven by investment demand into gold. Likewise, into pockets of sectors, we have seen done very well this year into things related to tech, 5G, AI, esports, healthcare, biotech, pharmaceutical. We have seen these upsides as well. And conversation-wise, we are also getting ESG conversations, which I believe that this has kind of accelerated the market adoption of ESG. Though we are still some years away from where we ideally like the adoption to be, but we are seeing that adoption has increased in a way that has brought on by structural changes due to the pandemic. In terms of the other areas that we have seen, I guess the next question where people are thinking about is what is 2021? The conversations around, is it time for cherry picking into over lofty valuations, into stretch PEs? So where are we seeing demands? So next year we tend to favor areas like EM, where we tend to favor EM local currency. We tend to continue to favor the space where we talk about fallen angels, where investment grade corporate debts, corporate credits are downgraded and gets into the high use space, and we see that as a big driver of demand. And also in terms of the where we continue to drive our efforts would be very much around looking at trends or investment opportunities that is not covered by the market. Like for example, there's so much discussions around, like smart energy, smart solutions, renewables, crypto, and that continues to be where we see as an pocket of allocation for investors' portfolio. So in a nutshell, the year has certainly been one of great note for passive flows. And then we think that next year would be one where we see that sectorials and thematics will continue to play out well in that space.
Much, Richard. So sorry to cut everyone off, but it's almost 12 and almost reaching the end of our session. What I would like to do is actually a last poll right now. And thank you so much for sharing your flows and also for Damo for sharing your views and insights on this session. I think maybe we'll have a follow-up session, another one for people to continue asking questions to both of you. Yeah, based on the feedback, it's actually quite good. So the last question that we'd like to ask, right, to round off this session is, do you think that ETFs will eliminate the role of active managers? I asked this question early on. So I believe the numbers were something like around 70 over to 80%. So from what I can see here, there's a larger number of participants that actually say no, that ETFs will not eliminate the role of active managers. And what I think generally both speakers would like to share and also appreciate and hope the audience can appreciate is that eventually there will be a convergence of actually the views, these two products basically, and the type of strategies, passive and active management styles, methodologies, and all that. And eventually, the people who will benefit the most will be the consumers. And people like us in the industry will have to work harder to overcome the challenges and work harder to actually bring even better solutions to the audience and to existing investors right now. Okay, so thank you so much, Damo and Richard and Damo, and to the audience. Have a good day and have a good lunch. See you.
Thanks, Bernice.
Thank
Thank
you,
you.
UOBA. Thank you very much, everyone.
Okay, goodbye.